Hi, Adam Gower here. Thanks for joining us. I am founder of GowerCrowd and host of the real estate reality show on YouTube at youtube.com/GowerCrowd. Today is the second in our series of weekly updates. I am joined by Dave Saxe, managing principal at Calvera Partners in San Francisco. And Dave, what have we got in the news this week? The first thing, of course, really can't avoid it.
Oh, there's so much good stuff in the news this week. It's such an interesting and dynamic time. Every day, a new article, new story comes out that's very relevant. So the one that I think we'll start out with today, and I can let you introduce it, is the stories about what's going on over at CrowdStreet, or maybe more importantly, Nightingale.
Well, that's right. Yes, this deal, it was the biggest raise on the CrowdStreet platform in their history, 50-something million. I forget the exact number, and it's all gone missing. Apparently, they CrowdStreet investors started to complain, and CrowdStreet put in not a receiver but somebody to manage the assets, who discovered that the accounts were empty. So it's a big deal. It's a big deal for crowdfunding.
Absolutely. Definitely some fraud going on, probably on Nightingale's side. I believe I also saw, given that they're one of the groups out there, particularly in office, that I think has some other trouble. I read a couple stories. You never know what the true story is, that, some of those funds, they could have been used to help other properties. The long and short of it was pretty mind-blowing to me that all of that money could be raised from accredited investors and just disappear or not released until there was an actual deal that happened. That was the mind-blowing thing for me.
That it was right. So it's funny, because I actually, when you said that amount of money could be raised from accredited investors, I actually thought you were going to finish that sentence by saying in so short a period of time.
Oh, for sure. What CrowdStreet has done in terms of the ability to generate capital for deals, funds, they, along with Realty Mogul, it seems like, I was always wondering who the winners would be, but CrowdStreet has just done an amazing job raising more capital than I ever thought could be done. And you're the expert on this online. It's blown my mind.
Well, so far, I was on their website just a few minutes ago. It's over 4 billion, 4.1 billion in equity from accredited investors. I don't know if that's all accredited investors or some institutions, but either way, using new regulations that allow for general solicitation, basically from individual investors. But you got to put this Nightingale thing in perspective. First of all, and I don't like to use the past tense, right? We don't know. Everything is alleged as it stands today, Dave, right? So everything's alleged, but we're just taking this from the news that we see. At the time the money was raised, Nightingale were an extremely high credit sponsor. That's number one, right? It was hard to fault anybody for making a decision to work with them, particularly at that time. Secondly, in the context of what CrowdStreet has done, of course, bad news is red, right? What do they say? If it bleeds, people read it. Or I don't know. Right? So that's what's risen to the top of the news cycle at the moment. But from what I see in articles on BizNow and on The Real Deal, commentary from Torstein over there at CrowdStreet, you got to put that into perspective. 770 deals in their entire life so far. And this is one that's really done a somersault like this.
Absolutely. The other thing too, to your point, you don't fault them for working with them. I read in the articles, they had references from huge institutional players. I think I saw KKR. It seems like they did their homework on their legitimacy. I think what seemed to be an issue here, and again, to your point, it's been one, but it's a big one, and you don't know what will happen due to this. What safeguards were put in place and what processes were put in place to kind of protect that capital until they knew the deal was getting done. And I would imagine that some processes over there are changing.
Yes, and I think they've changed like within the last few days as well. But again, oftentimes, and I think this actually speaks to what are we really seeing here, right? What are the lessons to be learned from this event in the bigger picture of crowdfunding and accredited investors? A lot of times, or many times, you only learn lessons when you make mistakes, right? There's the right I'm reading a book at the moment, The Gift of Failure, right? The Gift of Failure. I mean, in my business, we test things, we try things all the time. And 9 times out of 10, they fall completely flat. You could call them total failures. But 1 in 10 times, it's a home run, and then we double down on that. And commercial real estate is no different in the sense that there are cycles. And cycles and downturns are inevitable. And this is and so you learn from those. And this is the first time thousands and thousands of accredited investors have had the opportunity to invest like this. This is the first time they're learning the hard lesson of a downturn.
Absolutely. And cycles. I mean, I started my career at Equity Office in the research group, working for Sam Zell right after the .com cycle. Worked at CIM Group in LA during the GFC, and then obviously doing my own thing during the pandemic. And I do get asked a lot of questions from my accredited investors. Have you worked through cycles? What did you learn from them? And the fact that I had said that I had was definitely important to some of these more experienced investors. And then back to your point, that due to the regulations changing, and this is true of my own company for most of my existence, rents in multifamily, which is what we do, are going straight up, and interest rates were really low. And so it was, you still had to be smart, don't get me wrong, but there was some ability to do some financial engineering. It seemed like some pretty easy returns, et cetera, et cetera. So things change in real estate. They can change quickly. And that's what we've seen here, and why we're seeing all the stories across the board in the paper about groups largely raising money from accredited investors who are learning the hard way, to quote you, that things don't always go up and to the right forever.
Well, look, it's easy to be cynical, right, about novice sponsors that have just come into the market and have found an easy path to raising capital over the last few years, who don't, quote, really know what they're doing. What does that mean? It means they've not been through a cycle. And you really have to go through it. It's almost impossible. Look, we have a lot of courses, and I train sponsors in what to look for and to be cautious and how to protect yourself against a downturn. But until you actually go through one and actually suffer losses, you really don't appreciate it. I was talking to somebody the other day. It's like telling your kid, don't play with knives, right? They won't know why that's a bad idea until they cut themselves, right?
Absolutely right. I mean, during the Equity Office phase, I mean, I had to track the rents in equity offices, Silicon Valley buildings, Sand Hill Road, peak venture capital. It was mind-blowing to me to see that spreadsheet and having rents go from $100 to $20. And then during the GFC, just remembering sitting at my desk and watching all the banks crater. I mean, this is some scary stuff that you don't forget, and it impacts the way you look at deals going forward and the focus that you have to have. And you can't be perfect. Look, I mean, I'd be lying to you if I said I knew interest rates were going to spike this quickly. That being said, how to mitigate your risks when you buy a building is all that's been hammered home to me, working for large institutional shops, which is incredibly beneficial than while being the custodian of accredited investor capital.
Well, that's right. And my experience in institutional capital is always to run 3 sets of analysis, right? Best scenario, worst scenario, most likely. And you really want to stress test your numbers. And that's been the challenge over the last few years. I think we touched on this last week, is that sophisticated multi-cycle sponsors who have suffered the pain of loss and have consequently become more conservative in their underwriting have had a challenge competing against newcomers to the industry, because newcomers don't have that sense of defensive sense when they're underwriting their deals. And so they're putting forth 25% IRR. This is what we can get for you, right? And so guys that have been through it are competing against that with 12 to 15%. Doesn't look as good. It makes you look. How do you deal with that, right?
But it's so frustrating. And because it, particularly in multifamily, I guess all the real estate market, but let's just focus on multifamily. That's probably the extreme. As I mentioned, we were writing a quarterly newsletter since 2011 to our investors. And I used to say, I've never had to write a newsletter when we talk about the market in multifamily where rents went down. And then on top of that, you had the low interest rates. So you're right. We would sit there and get outbid, particularly last year, by 20 to 25%. People were putting on bridge debt on top of senior debt, maxing out all their assumptions to make it work. And it was frustrating because clearly we're in the business of doing deals, but we have to be patient. So to answer your question, what did you do? You use a lot of mental strength to sit on your hands or on your checkbook, and you wait, and you know that something eventually is going to shift. And I think we're probably getting there now.
Well, so, kind of coming full cycle back to the CrowdStreet Nightingale story, the experience that, look, nobody wants to lose money. In fact, people are more motivated, are more driven by avoidance of loss than they are to acquire gain, right? Rather, give up gain in return for protection. But in this situation, you're looking at the first time a lot of investors, accredited investors, are going to experience that. Now, all being well, they will have invested across a broad range of deals, right? And so this is one deal in a diversified portfolio. But look, the classic marketing story, if you look at the really good marketers, digital marketers out there, they always, or the personalities, they always have a rags to riches story, right? It's the same idea that you got to go through loss to really appreciate gain and see the world. It's the rags to riches story. They always start with how I had nothing, right? Or how I lost everything. But it's because of that. What's compelling about that is that you do triumph out of this, right? There is triumph. You do learn something. And that's, like I say, the only way that you can in real estate is by actually going through a downturn. So what are the lessons, right? I mean, fraud is one thing, and that's alleged over here. So there's nothing you can do to avoid that. That we don't know if that's the case over here with Nightingale.
We don't know it's the case. Yeah. Go ahead.
What are the lessons then that an investor sitting here, looking down the barrel of a 25, 50,000 loss on a deal, whatever it is, what do they learn and how do they act? Do they run to the stock market, never return to commercial real estate? Or is this an opportunity today to cut your losses and double down on some distress acquisitions, for example?
Yeah, I mean, the first lesson is one we've already touched on and pretty obvious. And it sounds like, to CrowdStreet's in their defense, right? They had very good references from companies I'm aware of, but just in general, even outside of this situation, doing the due diligence on the sponsor, just making sure that the guys are trustworthy, have a track record. As I mentioned earlier in this discussion, it's helpful to know that they've worked through cycles, that they've seen distress. We've touched on that a lot during this call. So that's the first one. Two would be read everything. So, and this is getting in the weeds a little bit. Investors, there's a lot of trust from accredited investors to the sponsors, to CrowdStreet. The legal documents that you read are long and painful. We spend a lot of time and money preparing them. We take pride in being very, for lack of a better word, anal on making sure we've read everything, that our investors are protected. So, but still, I know a lot of my investors do not read all of the operating agreement. It's painful.
Look, here's let me just jump in on that.
Yeah,
quite right. So I spent quite some time. We actually produced a course. I produced a course on what to look for in offering documents when investing in commercial real estate. To do that effectively, I read a lot of contracts. Some of them I downloaded were 80. Dave, 80,000 words long. That is a fairly long novel. That's the length of a long novel, right? Incredibly complicated. And the fact is, and this won't change, but the fact is that when you are investing $25,000 or 50 or even 100 in a deal that's raising 50 million, even 10 million, you have no negotiating rights on those contracts. So when you read them, and understand that your likelihood is you've got very little voting power, right? You've got no material control over what happens. Right? It's a Hail Mary almost in terms of signing a contract. You really are placing your trust in that sponsor's hands, that at least you go in and realizing that from day one. What I'm seeing online at the moment is, hey, I just got a capital call, and I've read the contracts for the first time, and I'm shocked to see they have the right to do this and I have nothing I can do. Hey, right? It's the wrong time to read the contract. Go in with your eyes wide open and accept the fact that that's what it's going to be.
Well, you'll also get good over time reading it, and then they become, trust me, easier to read. But that goes back to lesson number one, which is you are trusting the sponsor, which in our case would be me or whoever else, to negotiate and put in their terms that are market terms that make sense, that mitigate risk, so that after you read them and you've done your due diligence on the sponsor, you're feeling pretty good about the situation, and that you've agreed to something in an operating agreement that works in everyone's favor. Because the last thing I want is investors to be unhappy either, right? But at the same time, I need them to be protected as much as possible. And that's huge.
Look, we could go into, this is a whole different topic. We get into the weeds on this, but probably the most important thing to look for if you have no rights, right? Essentially, as an individual investor in a huge deal, probably not going to have, is an alignment of interest. You just want to see that the sponsor stands to lose if you lose, that they're motivated in the same way, that they're not motivated by fees entirely, that there's an alignment of interest, that they're going to do well if you do, and they're going to suffer if you don't.
100%. And any savvy long-term investor that may have more money to raise. So for better or for worse, when you put something on CrowdStreet, and again, they've been impressive just creating this industry and growing it and everything else. But when I interact with folks that maybe give me $250,000, who have a lot of investing experience over decades, they are going to ask me those questions and not participate, or I'm going to learn over time what I need to have in there. If you're raising money in $25,000 checks, there's something wrong with that, other than I would say, I don't know who's checking everything. And you don't have that big gorilla investor or a group of them that's going to hold me over the fire and make sure that I'm putting everything that should be put in the docs.
Exactly. I'll tell you what, let's move on to our next topic. So I actually had pointed towards hotels because I've saw some folk that I know very well losing hotels, but let's pass over that and talk about how wonderful, actually, I know you're up there in the Bay Area, how easygoing the administration up there in Oakland is on rent control. Apparently, they allow annual increases in rent. Isn't that nice in comparison to Los Angeles? I know that's not what you were pointing out. It's the eviction moratorium that's ending, right? So just why don't you explain what's going on, and then I will remove tongue from cheek and compare it with Los Angeles. Go ahead.
Absolutely. Yeah, we're both based here in California, which is, it's becoming increasingly difficult to be a landlord. I will say that because I'm from California, because I'm from the Bay Area originally, it's not surprising that a lot of my investors are based here. And it's been an absolute fascinating experience to watch my investors political views change in real time as it impacts their pocketbooks.
While you're talking to them.
Including my own family. They're saying, well, and I'll explain it in a second. And they're saying, well, how can they do that? I'm like, well, they're doing it. And then I swear to God, they're voting differently the next time. But just to briefly summarize it, during the pandemic, many municipalities, let's just use Oakland for an example, but also Alameda County, where Oakland is based, and then the state of California, so 3 levels, had what's called an eviction moratorium. That made a lot of sense in that people were out of jobs, they couldn't go to work, and therefore we're going to be struggling to pay rent. So all in favor of that. What happened is that then some of the municipalities, the state of California, Oakland, Alameda County, whatever, were cutting checks to landlords to help for the lost rent. So the system was working, relatively well. There were some timing differences that I don't need to go into between when rents are owed and when the money came in fine. But then what ended up happening, and I say this sarcastically, in all of California's brilliance or Alameda County's brilliance or Oakland particularly, is the assistance checks ran out, say last March, or for example in Oakland, but California had the eviction moratorium going for a while. Then to their credit, they ended it. Oakland and Alameda County, though, extended it until very recently, a year after these assistance checks would come into landlords like myself. So what you then had happening is a number of tenants, and I know this for a fact, because we know our landlord or our tenants, particularly in mid-sized Bay Area rent-controlled buildings, were taking advantage of the system. And what I mean by that is you could have a full-time job. We know some people did. And just decide you don't want to pay rent. And the rules were such that there was nothing landlords could do about this. Long story short, then I'll stop and turn it back over to you, we're a fund. And as I've mentioned earlier, I think we're pretty good with being conservative and mitigating risks. So we have excess funds in our investment fund with accredited investors to ride the wave out a little bit. It wasn't fun, don't get me wrong, when you have 10 to 15% of your Oakland building not paying you rent. However, what really pained me to see was your small time mom and pop landlords who might own a 6-unit building in Oakland. There was nothing they could do about the non-paying tenants. And then they couldn't cover their loan payments, right, and the bank would foreclose on them. Oh, that was what was painful to see.
Was that happening? Was that happening en masse in Oakland? You saw that a lot, did you?
Look, I mean, these stories, because this is what we talk about every week, we're going to the front of all the papers, and it was happening enough. There was one guy that was so distraught about this that he was doing a hunger strike in front of city council to try and get them to end the eviction moratorium because he couldn't do anything about this. Right.
Yeah, it's brutal. I mean, during the again, you and I like to flash back to the global financial crisis. It's a good reference point. But that was the ones that really suffered were the small mom and pop shops that just had no skill set to deal with tenants that stopped paying rent. Right, no capacity, no awareness, consciousness, no resources, right, no money to deal with it. It's just to get like the only thing you can do is throw your hands up, basically.
And to put that in perspective, we have the skill set, we have the institutional background, we can hire lawyers, we can do whatever it takes. The system that has been in place and it just is ending was so intense. There's honestly nothing we could do, even with all of our resources.
Yes,
so everyone was in the same boat. It was pretty crazy.
Well, it's crazy, but here's the thing though. You're talking about an eviction moratorium. I read this article that you sent. Actually, we should refer to these articles. This was in NBCBayArea.com. There was an article, eviction moratorium, Oakland ends. Eviction moratorium. But what Oakland allowed was CPI plus 3% rent increases, for crying out loud. At least you could increase rents. Forget that in LA. In LA, not only was there an eviction moratorium, which admittedly did end earlier this year. So
They were the first, I think.
a few months ahead of Oakland. But for 3 years now, over 3 years, you cannot increase rents on rent-controlled properties in the city of LA. A freeze. This during a time, by the way, where you are seeing rent inflation across the country in double digits consistently, while interest rates are going up, costs are going up, maintenance costs are going up, taxes are going up. They didn't freeze taxes, right?
You can do a whole other call on rent control just by itself and what that does to the incentives or lack of incentives. But you're right, like the double whammy of all of that. And then like the joke's on the landlord now. And in that, now when they finally ended it, well, where are we now? Interest rates have skyrocketed, layoffs in the Bay Area. It's not a fun time to be a landlord, I guess, in California.
In California, this is why there's so much flight from California. One last point on that is this 5% mansion tax. Have you heard about this?
Yes. Oh, absolutely. I've read all
5%. So everybody that I speak to say, yes, 5% mansion tax. Suddenly you have a 25% co-owner. The city has suddenly become a 25% co-owner in my deal. Because if you think about taking 20% co-owner, if you take 75% debt and 25% equity, now you got to pay 5% to the city when you sell. They just became a co-owner in the bloody thing.
Oh, and one other thing too, just so you know, some of the tactics we were using, that we were going to the tenants, by the way, who had huge balances that were accruing, going to them and just being, if you are open to just, finding somewhere, we won't even go after all those thousands and thousands and thousands of dollars. And so then, and most of them, I think all of them did stay put, so it was just a crazy, nutty experience to go through. And we spoke about frustration earlier. This was peak frustration because there's just nothing you could do, even with all the resources and background in the world.
Right. And here's the other thing, is this idea of unintended consequences. Look, the politicians are, one presumes well-meaning, right? They want to see resolutions. They're elected to make the city better, etc. So but they are ill-conceived, and the unintended consequences actually cause more damage than they do good. And it's important to be able to recognize that. But that the biggest solution that I've seen sponsors making in LA, seriously, is to leave. Seriously, they've gone to Florida and Texas, literally packed.
We did well there. We followed, all the markets that we've talked about before. A lot of my friends in the Bay Area left for Austin. They left for Nashville. All these different Sunbelt states. I saw it firsthand in my own personal network. It's
real. People really are moving their families across country. All right, let's wrap up with one final topic from this week's news. And this is the continuing hot topic of U.S. banks stepping up. This article in U.S. News. Banks step up U.S. property loan tweaks to limit defaults. So this is interesting. So you sent this over. My view on this is that the difference today versus the global financial crisis during the GFC. The GFC was a true black swan. It was unexpected. Nobody knew what was going to happen, and it threatened systemic collapse. Basically, the system could collapse. And so the regulators stepped in and said, all right, we need to literally find bottom as fast as possible. We got to get there. Mark to market. And so all the banks had to mark to market, and that reduced the value of their portfolio. So a lot of banks failed. Mm-hmm. This time is different. Don't you love that expression? This time's different because this is a managed downturn by the Fed, by increasing interest rates. And so by the regulators advising banks to extend, and I don't think it is pretending this time, extend and pretend last time. This time is extend your loans, is because I think the regulators are anticipating a reversal. Whereas during the global financial crisis, we weren't sure if we were going off a cliff. This time,
we were.
This time there is an anticipation, and that's why they want to extend, because if they extend and there is a reversal in fortunes, in values, in CRE, all of these extended loans may come back to solvency, if that's the right word.
Absolutely. And I think we talked about this last week as well. I think a lot of banks, lenders, other financial institutions lending money realized last time during the GFC that they don't necessarily all want to be landlords of a lot of real estate, going back to skill sets and other things. That's not what we're in business for. There's other folks out there that might have that in their business plans, but not your generic bank. So that's another thing they learned from last time. I generally agree with you that they could see a recovery happening. You know, that might not be true everywhere, I think, as we touched on last week, but they just want to avoid a massive meltdown. So they're learning from mistakes, tying this back into other things, and trying to work with lenders and encourage lenders to work with sponsors.
Yeah, so it'll be interesting. There'll be less. It will inevitably lead to, well, there's two outcomes that are possible. One is it will either eliminate a lot of distress in the market, or it will just postpone the inevitable. Right? It depends on your perspective.
I think in certain areas, as we touched on last week, it's postponing the inevitable, but that we could do a whole nother call on that. Certain markets, I mean, I live in the Bay Area, downtown San Francisco, struggling. One could argue that could be a while. So I don't believe everywhere it's all going to just recover, but research your markets carefully when you're investing in any sort of syndicated deal. Going back to another one of the things we talked about.
All right, it's a perfect place to sign off this week. Thanks so much, Dave, for joining me. It's always a pleasure. I'm really enjoying these. So let's see.
Yeah, thank you.
Eventually, we'll press that live button, and I'll probably need to drink even more coffee before we do one of those. But anyway, thanks for joining me. Thank you, dear viewers, for joining. Do please go to GowerCrowd.com, where you will find links to all of these and to the Real Estate Reality Show podcast and YouTube show, and subscribe to our newsletter. It goes out every Wednesday, covers the world of real estate syndication and crowdfunding, and covers the topics that Dave and I talk about here on Fridays. And if you are watching us on YouTube, and even if you're not, go to youtube.com/GowerCrowd and subscribe there. My goodness. That way, when we do go live, you'll get actual emails, I think, from YouTube that will alert you to the fact that we've gone live, and you'll be able to join in the conversation. We would love to hear from you on those occasions. That's it. Thanks so much for joining us this week. Dave, thank you again. And thank you, dear viewers. That's it for now. I'll see you next week. For now, this is Adam Gower signing off.